everyone. This is the answers to the Unit 6 exercises. The first question you had was on the aging of receivables method. And in the aging of receivables method, each company breaks down their receivables not only by the companies that owe them money, but how long each individual receivable has been outstanding. For Banjo board games, they have trade receivables from 5 different companies. They are Fun Zone, Games R Us, Bullseye, J-Mart, and KJ Toys. They have broken down the receivables from these 5 different companies into 5 different age groups: under 30 days, 31 to 60 days, 61 to 90 days, 91 to 120 days, and over 120 days. The first thing you need to do is find the year-end balance for each company. So for Fun Zone, they have a $60,000 receivable that's been due for under 30 days. They have a $12,050 receivable that's been due for 61 to 90 days. In total, Fun Zone owes Banjo Board Games $72,050. Games R Us has a $20,000 receivable that's been outstanding for 31 to 60 days, and one that's been outstanding for over 120 days of $5,000. In total, they owe Banjo $25,000. Repeating this concept, we see that Bullseye owes $18,450 to Banjo, J-Mart owes $10,500 to Banjo, and KJ Toys owes a whopping $86,000 to Banjo. Next, we need to find the total for each of the 5 different time periods. So for under 30 days, we have a $60,000 receivable from Fun Zone, a $14,000 receivable from Bullseye, and a $54,000 receivable from KJ Toys. If we add that up, that's $128,000 worth of receivables that have been outstanding for under 30 days. For 31 to 60 days, Games R Us owes $20,000, Bullseye owes $4,450, and J-Mart owes $6,550. If we add all of that up, we're going to come up with $31,000 in receivables on Banjo's books that has been outstanding for 31 to 60 days. Repeating this concept, we see that Banjo has $16,000 worth of receivables that have been outstanding for 61 to 90 days. That $132,000 receivable has been outstanding for 91 to 120 days, and $5,000 of receivables have been outstanding for over 120 days. Now, if we add up the total of the year-end balance column and the total of the amount of receivable we have for each of the 5 different time periods, they're going to come out to the same number, which is $212,000. Good way to check here. So we have $212,000 of receivables on our books, broken down both by company and by how long those receivables have been outstanding. To establish or to set our allowance for bad debt, what we need to do is we need to come up with some kind of estimate of what percentage will be uncollectible for each different time period. And the longer a receivable has been outstanding, the less likely it is to be collected, so Banjo is going to use this table. For receivables that are outstanding for under 30 days, there is a 2% probability that it is going to be uncollectible. Well, Banjo has $128,000 in receivables. So if you take that $128,000 in receivables that have been outstanding for under 30 days, and you multiply it by that 2%, you get $2,560. Do this concept all the way down the line. For 31 to 60 days, Banjo has $31,000 worth of receivables on its books. There's a 4% chance of uncollectability, so let's add another $1,240 to our required allowance balance. They have $16,000 of receivables that have been outstanding for 61 to 90 days. If we multiply that by 8%, we get $1,280. They have $32,000 worth of receivables that have been outstanding for 91 to 120 days. If we multiply that by 16%, we get $5,120. And lastly, that $5,000 receivable that's been outstanding for over 120 days has a 32% chance of being uncollectible. If we multiply 32% by 5,000, we get $1,600. Now, if we add up all of the numbers that we have in our required allowance balance column, we're going to come up with $11,800. That is the target balance for our allowance for bad debt or our allowance for doubtful accounts. And we can use that number to record the journal entry that is going to set our allowance to its target balance. Banjo is just switching to using the allowance method, so they don't have an allowance on their books. But they know from the calculations we did, they have to get to a balance of $11,800. Well, since they're just switching right now and there isn't an allowance, the current balance is 0, which means they need to make an adjustment of $11,800 to increase that allowance to its target balance. They're going to record the entry on December 31st by debiting bad debt expense for the $11,800 adjustment amount. and they're going to credit allowance for bad debt for the same amount. And what they did is they established their bad debt allowance. We have another aging of receivables question, this time for Wilson Wire Mill. They have 5 companies on their books with different age periods for the receivables broken down on this table. We're going to do the same steps that we just did in exercise 1A. Starling Steel has $43,000 worth of receivables on the books. Ithaca Iron Works just has that $125,000 receivable. Braddington Machinery owes Wilson Wire a lot of money. They have $20,000 that have been outstanding for 31 to 60 days, $66,700 which has been outstanding for 91 to 120 days, and $18,556 which has been outstanding for over 120 days. So if we add that all together, Braddington Machinery owes Wilson Wire $105,256. Relax Radios has a year-end balance of $11,750, and Western Auto Incorporated has a balance of $113,000. We have our year-end balance for our 5 companies. Let's find our total for the 5 different time periods that we have for under 30 days. We have $30,000 from Starling Steel, $25,000 from Ithaca Iron Works, and $7,800 from Relax Radios. We add that up, we get $62,800. For 31 to 60 days, the total amount of receivables on our books that has been outstanding for that time period is $33,000. It is $84,950 for 61 to 90 days. It is $98,700 for 91 to 120 days. And the only receivable we have on our books, which has been outstanding for over 120 days, is at $18,556 from Braddington Machinery. Again, the sum of our year-end balance column and the total row for our 5 different time periods are both going to equal the same number, and it's $212,000. So now we have the total amount of receivables on our books broken down by both company and age range for how long it's been outstanding. We can use that information to compute our target balance for our allowance for bad debt. These are the percentages that Wilson Wire is going to use. So for under 30 days, we have $62,800 worth of receivables, which are on our books. We estimate 1% of them will never be collected, which means we need to add $628 to our required allowance balance. We have $33,000, which has been outstanding for 31 to 60 days. If we multiply that by 3%, we get $990. $84,950, which has been outstanding for 61 to 90 days, times a 10% chance of uncollectability, means we should increase our allowance by $8,495. 91 to 120 days is $98,700 worth of receivables. Multiply that by our 20% probability of uncollectability. $19,740 is getting added to our allowance. And lastly, we take that $18,556, which has been on our books for over 120 days. We multiply that by the 30% chance of uncollectability, and we come up with $5,567 rounded off. In total, when we add up all of those 5 numbers in the required allowance balance column, we figure out that the target balance for our allowance for doubtful accounts, or our allowance for bad debt, is $35,420. Wilson Wire is not establishing this allowance for the first time. They already have the allowance on the books, and as of the time that they are making this adjustment, their allowance has a credit balance of $9,920. Well, we just figured out that the target balance was $35,420. If the balance is currently $9,920, they need to make an adjustment for the amount that is going to increase it from its current balance to its target balance, which is $25,500. And they're going to record it using the same exact entry, December 31st. We have a debit to bad debt expense for the amount of our adjustment, which is $25,500. We credit allowance for bad debt for that same amount, $25,500. We adjusted our allowance for bad debt to its target balance. In exercise 2, we are issuing a note, this time at a discount. Wilson Wire is making this loan to Boardman Electronics, and for this loan they are receiving a 4-year $12,000 note at 9% interest. So Boardman's going to pay back $12,000 4 years from now, but in the interim they're going to send them 9% of face value every year as an interest payment of saying thank you for letting us borrow money. This 9% that they are charging is below the market rate of interest. So companies lending money to other companies of similar risk to Boardman Electronics are actually charging 10%. We're giving Boardman a discount on the amount they have to pay us each year for those interest payments. Well, we need to find the present value of the note. And to find the present value of the note, we need to find 2 things first. The present value of face, which is that $12,000 we're going to receive 4 years from now, and the present value of interest, which is that series of payments that they're going to pay at the end of every year for the next 4 years. And if we add those together, we get the present value of the note. To compute what the present value is of both of these, you're going to need some methodology to convert it to present value. Spreadsheets are a great way to do this, but we're going to do it using the table that I have provided for you. This is the face, which is just one lump sum. We're getting one lump sum 4 years from now of $12,000. So because it is one lump sum, the table that we're going to use is table A3, which is the present value interest factor for $1 or for one lump sum. We need our inputs, which is our I and our N. The I is always the market rate of interest, and it was 10%, and the N is the years to maturity, which is 4. On table A3, we need to go find a spot where 10% and N equals 4 intersect, which is 0.6830. So we have our present value of one factor. Well, we can convert that face value of $12,000 to its present value by simply multiplying it by its present value of one factor. The present value of one factor is 0.6830, and we multiply that by 12,000. We get $8,196. Now we need to figure out the present value of interest. We're going to do the same thing that we did before. Our I is still the market rate of interest of 10%. Our N is still the 4 years until maturity. But since this is for interest, we're not going to use the present value of one table because it's not one payment. It's a series of payments that come at a regular time in a regular amount, and is therefore by definition an annuity. So you want to use table A4, which is the present value interest factors for a $1 annuity. So face value is table A3. Interest comes from table A4. But we're going to do the same concept. We're going to take the intersection of those two numbers, which is 3.1699, and we're going to multiply it by the amount of one interest payment to find the present value of those interest payments. Well, how do we find the amount of one payment? We go and we take face value and we multiply it by the stated rate on the loan, the note that we are getting from Boardman Electronics, which was 9%, not the 10% market rate, but the actual amount of interest they're going to pay us each year. So if it has a $12,000 face and they're going to pay us 9% of that face value every year as an interest payment, each interest payment is going to be $1,080. And if we multiply that by the present value of an annuity factor of 3.1699, we're going to come up with $3,423.49. So now, for this question, we're ready to figure out what the present value of the note is. The present value of face was calculated as $8,196. The present value of interest was calculated as $3,423.49, meaning the present value of our note is $11,619.49. We need to record the entry on January 1st for when Wilson Wire is going to issue this to Boardman Electronics. Well, the face value was $12,000, but the present value of our note was only $11,619.49. And when you send out a note to another company, it's discounted. You don't give them cash equal to the face value, you give them cash equal to the present value. So we're basically discounting the amount of money that we give them because we're charging them less interest. We're not going to give them the full 12 grand. We're going to discount that decreased payment up front, and the amount that is discounted by is the difference between those two numbers, which is $380.51. So when we issue this on January 1st, we're going to put the note receivable on the books. And even though we're issuing it at a discount, Boardman Electronics is still going to owe Wilson Wire Mill the full face value at the time the note is repaid 4 years from now of 12 grand. So that's the amount we should put the note on the books for. So we debit notes receivable for $12,000. We put the discount on the books at its value, which we just determined to be $380.51. This gets credited because discount on notes payable is a contra asset account, and contra assets increase with a credit. And then lastly, that present value, $11,619.49, is the amount of cash that we are going to give Boardman at this time. So even though we're only giving them $11,619 now, they're going to owe us 12 grand 4 years from now. So we're issuing this note at a discount. Now we need to prepare the amortization table for this note that Wilson Wire Mill is sending to Boardman Electronics. The first thing you want to do on the date of issuance is put the amount of cash that was sent out, the discounted value, if you will, in your carrying amount column. So this note has a carrying amount of $11,619.49 at the time that it is issued. We're going to be using the effective interest method of amortization, which is going to take into consideration the market rate of interest. But the first thing we need to do is figure out how much cash Wilson Wire Mill is going to receive at the end of every year. Well, we already did that when we were finding our present value of an annuity factor. It was $1,080. That's the amount of each interest payment. For interest revenue, if we take the last known carrying amount, in this case $11,619.49, and we multiply it by that market rate of interest of 10%, we get $1,161.95. That is the amount of interest revenue that Wilson Wire is going to be able to recognize on their books during the 2019 year. The amount of discount that gets amortized on our books is interest revenue minus cash received. So if we're recognizing $1,161.95 of interest revenue, but we're only receiving $1,080 in cash, well, the other $81.95 that's in excess of the cash received is how much we're going to have to amortize the discount by. And now we can change our carrying amount by taking our last known balance of $11,619.49 and adding to it that amount of discount amortization of $81.95, which is going to increase our carrying amount to $11,701.44. In 2020, cash received is exactly the same, $1,080. Interest revenue, we're going to take the last known carrying amount, which is $11,701.44 right now, multiply that by the 10% market rate of interest, and come up with $1,170.14. And to find our amount of discount amortized, we take interest revenue minus cash received and come up with $90.14 for the 2020 year. To increase our carrying amount, we're going to take the last known balance of $11,701.44, add to it the $90.14, and we're going to increase our carrying amount to $11,791.58. In 2021, cash received is still going to be $1,080 because it's never going to change over the life of this note. Interest revenue, we take the last known balance, multiply it by 10%, we get $1,179.16. And when we take that $1,179.16 of interest revenue, subtract from it the amount of cash we received from Boardman Electronics interest payment, we get an amount of discount amortization of $99.16. Add that to the last known carrying amount, and it increases the carrying amount of this note to $11,890.74. In the last year of this note's life, we're going to get one more payment of $1,080. Interest revenue is still 10% of our last known carrying amount, so that's going to be $1,189.07. And the amount of discount being amortized is the difference between those two numbers, which is $109.07. We add that to our last known carrying amount, and we increase this to $11,999.81. Well, our face value was $12,000, and at the end of a note's life, your carrying amount should be equal to your face value. So why is it off? Because we've been rounding. The table that we used for our annuity factors rounded off to 4-ish decimal places. Every time that we've been calculating using this table, we're rounding off to the nearest penny. Well, we lost 19 cents in rounding. So how do you fix this situation? In the real practical world, you just add those 19 cents to the interest revenue and discount amortized in the last period. 19 cents is pretty immaterial, so no one's going to care if you just, use this fudging method, if you will, to increase your carrying amount equal to the note. But for the purposes of your homework, you can leave it as $11,999.81. I'm fine with that. So, lastly, we need to record the journal entry on December 31st, 2019 to record the receipt of the first year's interest and amortization of the discount on this note that Wilson Wire issued to Boardman Electronics. Well, if we go back to our amortization table that we made using the effective interest method, in the 2019 year we had $1,080 of cash received. Our interest revenue that we get to recognize is $1,161.95. And the amount of discount we're going to amortize is $81.95. We're going to use those three numbers to fill in this journal entry on December 31st. We start by debiting cash equal to the actual amount of money we're receiving for interest, which was $1,080. We're going to have another debit to discount on notes payable for the amount of the discount that we amortized, which according to that table was $81.95. And our credit is going to be to interest revenue for the amount of interest we get to recognize during that year, which was $1,161.95. We received interest from this discounted note. Lastly, we have exercise 2B. And exercise 2B is pretty similar to exercise 2A, but instead of issuing cash to another company purely as a loan. This time we're going to sell equipment to that other company, and instead of getting paid for that equipment up front, the company that we are selling to is going to sign a note. So Alpha Incorporated is going to sell a piece of equipment with fair market value of $40,000 to Betadine. And in exchange, Alpha is going to receive a $40,000 6% 3-year note from Betadine. This note, just like the last one, is going to pay interest annually at the end of each year. But we got a big difference here. The market rate of interest at the time of sale is 5%. So Alpha is charging Betadine 6%, but notes of similar risk are going on the open market for 5%, which means we are charging more than the market rate of interest, which means this note is not going to be issued at a discount. We're actually charging them a premium. So the equipment that we are giving up has a carrying value currently of $38,000, which is its $60,000 historical cost minus the $22,000 that we have depreciated already. We need to determine the premium on the note receivable, and we need to record the journal entry on Alpha's books for the sale of this asset in exchange for a note. We're going to do so the same way that we did before, by finding the present value of face, the present value of interest, and adding them together to find the present value of the note. For the present value of face, we need to go to table A3 again, the present value of one table, and we need to use our factor inputs of our I and our N, I being the market rate of interest, which in this case is 5%, and N the years to maturity. It's a 3-year note. So we go and find the intersection of 5% and N equals 3, and we come up with 0.8638. Doing the same calculations we had before, we're going to take our face value of 40 grand. We're going to multiply it by that present value of one factor we just found of 0.8638. And we're going to come up with a present value of the face value of this note of $34,552. We need to add to that the present value of interest. So our I is still 5%. N is still 3. These factors do not change, but we need to go to table A4 now because this is a series of interest payments, so we need to use the present value of an annuity table. We find the intersection of 5% and 3, which is 2.7232. And we calculate it by taking the amount of one interest payment and multiplying it by that factor. The amount of one payment in this example is the face value, which is $40,000, times the stated rate of interest. We are charging them a higher rate of interest than market rate of interest, which is 6%, which means each time we're going to receive an interest payment on here, it's going to be $2,400. And if we take that $2,400, multiply it by our present value of an annuity factor of 2.7232, we're going to come up with present value of each interest payment, of all interest payments, of $6,535.68. So now we can figure out the present value of the note that Alpha Incorporated is receiving from Betadine for the sale of this piece of equipment. The present value of face was $34,552. The present value of interest was $6,535.68, meaning the present value of the note is $41,087.68. We know this has to be correct, or at least close to correct, because if we're issuing a note that is at a higher rate of interest than the market rate of interest, well, the present value of that note should exceed its face value, and it does here. The face value is only $40,000, so our present value is higher, which means it's issued at a premium. How much of a premium? We'll take the present value of the note, $41,087.68, subtract from it the face value of 40 grand. The premium is $1,087.68. On January 1st, when we record this entry, we're going to start by putting the note on our books. And the note is going on our books at its face value, and its face value is 40 grand. We're going to put the premium on the books, and the premium is an adjunct asset account because it increases the value of this note, and since it's an adjunct account, it goes up with a debit because assets go up with a debit, which means we are going to debit premium on notes payable for $1,087.68. Lastly, we need to also take this piece of equipment off our books that we're selling. Well, accumulated depreciation of equipment typically has a credit balance, so to take it off the books, we're going to have to debit it by how much we depreciated this equipment for. We've depreciated it for $22,000. Our credits. First, we got to get rid of equipment, and equipment is carried at its historical cost of 60 grand. And we're going to have a gain here, and the gain is whatever makes our debits equal our credits. So if we went through and we added up all of our debits, figured out what that number minus 60,000 was, we're going to come up with $3,087.68 as our gain on equipment sale. Essentially, we are getting more money than this equipment is worth according to our books. So we have to recognize a gain on this, which is going to be essentially an equity account going up with a credit. We issued this note at a premium. We can check to make sure our gain of $3,087.68 is correct. First, we should take the face value of the note, which is 40 grand, add to it the premium we found, which was $1,087.68, which means the carrying amount of the note at the time that we are issuing it is $41,087.68. Well, if we take the book value of our equipment, which was $38,000, that $60,000 historical cost less than $22,000 in depreciation, we take that $38,000, we subtract it from the carrying amount of our note, we come up with $3,087.68. So it's another route of finding the gain on asset disposal for the sale of this equipment. We're good. Numbers check out. So now we need to do the effective interest method again to prepare an amortization table for Alpha Incorporated's note that they have received from Betadine. We're going to start on the date of issuance by putting the carrying value of the note on the books, which was $41,087.68. On December 31st, 2019, we're going to receive our first payment of cash and interest, which we have already determined was $2,400. To figure out interest revenue, we take the carrying amount, the last known one, which was $41,087.68, and we multiply it by the market rate of interest, which is 5%. Comes out to $2,054.38. And if we take the amount of interest revenue we have, we subtract out the cash received, we're going to come up with $345.62. Yes, this will be negative. It's okay. It's going to decrease the carrying amount. If you want to do it the other way, that's fine. You can subtract cash received minus interest revenue to get to your premium amortized. Both ways will work. Because this is a premium and we're working our way towards face value, that means that we need to subtract out the amount of amortization we have, because we have to have the carrying value of this note equal to its $40,000 face value at the end of the note's life. So if we take our last known carrying amount of $41,087.68, we subtract, the premium amortized of $345.62, we come up with $40,472.06. This process is going to repeat itself all the way through this table. We're going to constantly multiply the last known carrying amount by the market rate of interest, find the difference between our cash received in interest and the amount of interest revenue we get to recognize. That'll give us our premium amortized, and we're going to keep decreasing our carrying amount of this note by the amount of premium amortized each year until we get to an end number, which should be the face value of $40,000. And again, we're off slightly. The reason that we are off slightly is because, once again, we are rounding. So typically in the last year you would go and you would turn your numbers around so that your carrying amount was exactly $40,000 at the end by decreasing the amount of revenue and premium that you're going to amortize. But this is fine for our purposes. We're going to just leave it as this. We're close enough. Lastly, we need to record the journal entry on December 31st, 2021 to record the receipt of cash from Betadine and the amortization of the premium. Well, if we go back to our table, 2021 is the last year, so we're going to receive cash of $2,400 from interest, but we're also going to receive the repayment of face value, which was $40,000, which means we are going to get in total $42,400. We already have our interest revenue and our premium amortized on our table. We can use those to prepare this journal entry. So we're doing the last line of this amortization table this time. So on December 31st, we're going to receive cash, and that cash again is not only the $2,400 in interest, but the repayment of the $40,000 of principal. We need to take the premium off of our books. The premium on notes receivable is an adjunct asset account. Typically goes up with a debit, but we want to decrease it, so it's going to go down with a credit, and that credit is for the amount that we had in our last line of our table, which was $381.04. We get to recognize interest revenue according to our effective interest method amortization table of $2,018.96. And lastly, we have to take the note off of the books because they are paying back the face value of it, and the note had a face value of $40,000. And thankfully, our debits equal our credits. We receive payment on note plus the last interest payment.